Welcome to the deep dive. We take source material, extract the key insights, and give you the shortcut to being truly well-informed.
Today, we're diving straight into corporate tax planning strategies. It's a complex world, but definitely a fascinating one.
Absolutely. We've got the sources right here, and they really lay out how corporations legally try to, well, minimize their tax bills.
And understanding this stuff is, it's more than just tax theory. It's a real shortcut to getting a handle on corporate finance, why companies make certain big decisions.
So our mission today is to pull out those essential concepts for you. We're going to unpack how companies manage when income or expenses get taxed. That's timing.
Right. And where that income or those costs land, maybe in different subsidiaries, different states or countries, that's income shifting.
We'll also cover the practical side, managing those quarterly estimated tax payments to avoid getting hit with penalties.
And crucially, the boundaries. What actually limits these strategies? Because it's not a free-for-all.
Definitely not. Okay, let's start at the beginning. The core purpose here, it's pretty simple, right? Corporations want to pay less tax.
Fundamentally, yes. They actively work to minimize the taxes they owe to governments. But it's not just about, hoarding cash.
Right. There's a purpose behind keeping that cash.
Exactly. The money they don't pay in taxes is cash they can use for other critical things. Internal investment is a big one. R&D, buying new equipment, expanding.
We're paying down debt, maybe.
Paying down debt, absolutely. Or returning value to the owners, the shareholders. That could be through dividends or stock buybacks.
So cutting the tax bill isn't just an accounting game. It directly fuels the business, frees up cash for strategic moves.
Precisely. The ultimate goal is always a legal and effective reduction in the overall tax liability. Optimization, like you said, not evasion.
And the source material gives us a framework. These three main types of strategies corporations use, their main toolkits, basically.
That's a good way to put it. First up, timing strategies.
Controlling the when. When does income count? When do you claim a deduction or a loss or a tax credit?
Then there's income shifting. This is about the who or the where, which specific company, entity, or which state or country reports the income or loss.
And the third one, estimated tax payments and penalty avoidance. Sounds a bit dry maybe, but getting those quarterly payments right is crucial.
Oh, absolutely. It's about managing cash flow throughout the year and staying compliant. Messing that up can be costly.
Good point. And we should also mention before we dive deeper that these strategies don't exist in a vacuum.
No, definitely not. You always have to weigh the tax benefits against, well, just plain old business sense. Does the strategy actually make sense operationally, financially?
And there are legal limits too, right? These doctrines the courts have developed.
Big time. We'll get into those, but they put real constraints on purely artificial tax planning.
Okay, let's tackle timing first. Playing the tax calendar, as you said. The main idea is influencing which tax year something hits the return.
Right. Income, deductions, losses, credits, trying to place them in the most advantageous year. But the key here is the corporation have to actually have the ability to influence the timing. Sometimes you just don't.
And what's the driving principle behind wanting to control the timing?
It almost always comes back to the time value of money. Finance 101, really.
$1 today is worth more than $1 tomorrow.
Exactly. You can invest that dollar today, earn a return. Waiting diminishes its value.
So how does that apply to tax timing decisions? Let's start with income.
Okay, income generates a tax cost. If you can legally defer recognizing that income, push it into a later tax year.
You push the tax payment into that later year too.
Right. And because of the time value of money, the present value of that future tax payment is lower than paying it today. You hold on to your cash longer, which is inherently more valuable.
Makes sense. Defer income, defer the tax costs, maximize the present value of the cash you keep. What about the flip side, deductions, losses, credits, things that save you tax?
For those, you want to do the opposite. You want to accelerate them. Claim them as soon as legally possible.
Why?
Because getting that tax saving, whether it's a deduction, reducing your taxable income, or a credit directly reducing your tax bill, getting that saving today is worth more than getting the exact same dollar amount of saving next year.
So you maximize the present value of the tax benefit, which lowers the real cost of whatever expense generated the deduction, for instance.
Exactly. So the standard timing playbook is defer income, accelerate deductions and losses and credits.
And the calculation involves, what, the amount of the item, the company's marginal tax rate?
And a discount factor. That discount factor is how you translate future dollars back into today's value. It's usually less than 1, reflecting that future money is worth less.
So applying that discount factor makes future tax costs seem smaller today, and future tax savings also seem smaller today.
Correct. The overall goal, mathematically, is to minimize the present value of tax costs on income and maximize the present value of tax savings from deductions. It all hinges on being able to legally control that timing.
Okay, let's make this concrete. A really common application is using tax attributes like net operating losses, NOLs, or capital loss carryovers.
These are valuable things sitting on a company's books, usually from prior years where things didn't go so well. They represent potential future tax savings.
And the timing goal with these.
Use them ASAP. The sooner you use an NOL or a capital loss to offset income and reduce your tax bill, the sooner you get the cash flow benefit and the higher the present value of that benefit.
Let's look at capital losses first. The corporate rules are pretty specific here.
They are. For corporations, capital losses can only offset capital gains. If you have excess capital losses, you can carry them back 3 years.
Against capital gains you had in those past 3 years.
Right. And you can carry them forward for 5 years against future capital gains.
3 back, 5 forward. So what's the immediate strategy that suggests?
Carry back first. Always. Why? Because carrying back generates an immediate tax refund for taxes you've already paid on those past gains.
Getting cash back now.
Exactly. Getting cash back today is almost always better than a potential tax saving sometime in the next 5 years. Any loss you can't use carrying back, then you carry it forward.
The source uses Bennett Corp as an
A
example.
lot of Canaccord. They had a $20,000 capital loss in year 4. They look back and see they had capital gains in years 1, 2, and 3. Let's say those gains totaled $11,000. 5K, 2K, 2, 4K.
So they can use $11,000 of their $20,000 loss right away by carrying it back.
Correct. They carry back $11,000.
Mm.
And the immediate impact. Assuming a 21% tax rate, that $11,000 loss carryback gets them a tax refund of $11,000 times 21%.
Which is $2,310.
Cash back in their pocket now.
Right away. That's the power of the carryback.
Okay, so they use $11,000 of the $20,000 loss. What about the other $9,000?
That $9,000 becomes a capital loss carry forward. It can be used to offset capital gains they might have in years 5 through 9. Up to 5 years forward. And this is where it gets interesting, right? The source mentions the expiration.
Exactly. That 5-year carry forward limit isn't just a rule. It creates a planning incentive. What if Bennett gets to year 9, the last year, they can use that carry forward, and they still have, say, $5,000 of it left unused.
It's about to disappear, become worthless.
Poof.
That
Gone. Unless they have some investments, maybe stocks or bonds, that have gone up in value, but they haven't sold them yet. Unrealized gains.
I see where this is going.
They might strategically decide to sell just enough of those appreciated assets in year 9 to trigger a capital gain exactly equal to the expiring loss,
So, sell assets to create a $5,000 capital gain.
which is instantly wiped out tax-wise by that $5,000 expiring capital loss carry forward. The net tax impact on that specific gain in year 9 is 0.
They pay no tax on that $5,000 gain they just realized.
Correct. They essentially used a tax asset that was about to expire to shelter a gain they might have otherwise held on to longer. It's proactive timing driven entirely by the expiration rule.
That's a clever way to avoid losing the benefit. Now, net operating losses, NOLs. Similar idea, but the rules got trickier recently.
They did. Big legislative changes mean the rules depend heavily on when the NOL happened. Specifically, whether it was generated in a tax year ending before January 1st, 2018 or after December 31st, 2017.
Okay, what's the difference? Pre-2018 NOLs versus post-2017 NOLs.
Older NOLs, the pre-2018 ones, have a 20-year carry-forward limit, but they can offset 100% of taxable income in a future year.
Wipe it out completely, potentially.
If the NOL is big enough, yes. Now, the newer NOLs, post-2017, have no expiration date. They carry forward indefinitely.
That sounds better. What's the catch?
The catch is they can only offset up to 80% of taxable income in any given future year.
Okay, so older ones expire but hit harder. Newer ones last forever but have an annual limit, and you have to use them in order.
Crucially, yes. You must use the oldest NOLs first. So if you have both types, you use up your pre-2018 NOLs before you can even touch the post-2017 ones.
Let's walk through the ACE Corp example. They have NOLs from both periods.
All right. ACE has a $40,000 NOL from 2017, that's the old kind, and a $70,000 NOL from 2022, the new kind. This year, their taxable income before NOL is $100,000.
First step, use the oldest NOL. the $40,000 from 2017.
That $40,000 NOL can offset 100% of income, so it reduces the $100,000 income down to $60,000. That 2017 NOL is now fully used up.
Okay, income down to 60K. Now they look at the $70,000 NOL from 2022. This one has the 80% limit.
And importantly, the 80% limit applies to the taxable income remaining after using any older NOLs, so it applies to the $60,000.
So they calculate 80% of $60,000.
Yes, 80% of $60,000 is $48,000.
Right.
That's the maximum amount of the 2022 NOL they can deduct this year, even though the NOL itself is $70,000.
So they can't use the full 70K this year, only 48K.
Correct. Their total NOL deduction for the years, the $40,000 from 2017 plus the $48,000 from 2022, totaling $88,000.
Exactly. And what's left of their NOLs? The 2017 one is gone. The 2022 one started at 70K. They used 48K, so there's $22,000 left. And that 22K carries forward indefinitely, still subject to the 80% limit in future years.
That's right. This example really shows how those different rules interact the ordering. The 100% fees 80% offset. It adds layers of complexity to using those loss assets.
It really does. Legislative changes just keep adding wrinkles. Now, another big factor for timing is changes in tax rates themselves.
Absolutely. Even if the main federal corporate rate stays flat for a while, state rates can change year to year. Or there could be talk of future federal changes. These shifts definitely impact timing decisions.
So how does a potential rate change affect the standard accelerate deductions defer income rule?
Well, if tax rates are expected to be constant or decrease in the future, the standard rule generally holds. You accelerate deductions to get the savings sooner at the current, higher or same rate. You defer income to pay the tax later at the future, lower or same rate. Time value of money reinforces this.
But what if rates are expected to increase?
That's where it gets tricky. Now you have competing factors. Accelerating a deduction gets you the savings sooner, good, time value, but at the current lower rate, bad.
While deferring the deduction means you wait longer, bad, time value, but you get the saving calculated at the future higher rate, good.
Exactly. You have to actually run the numbers. Does the benefit of the higher future rate outweigh the time value cost of waiting? For income, though, deferring it into a higher tax rate year is almost always bad news. You pay more tax, even if you pay it later.
The J-Corps examples illustrate this trade-off perfectly. Let's take the constant rate scenario first.
Okay. J-Court has a $10,000 insurance bill due next year, year 2. But they could choose to prepay it this year, year 1. The tax rate is a constant 21%. We need a discount factor to value next year's savings today. Let's say it's 0.926.
If they pay and deduct in year 1, the tax saving is $10,000, 21% equals $2,100. Since it's today, the present value is $2,100.
Right. If they wait and pay in year 2, the saving is still $2,100, 10K, 21%. But the present value of that $2,100 received next year is only $2,100.926, equals $1,945.
So $2,100 today is clearly better than the equivalent of $1,945 today. Accelerate the deduction.
Correct. Now, change one thing. Assume the tax rate is increasing from 21% in year 1 to 25% in year 2. Same $10,000 expense, same 0.926 discount factor.
Okay, paying in year 1 still gives a tax saving with a present value of $2,100, 10K, 21%.
But if they wait and pay in year 2, the saving is now calculated at the higher rate. $10,000, 25% equals $2,500.
And the present value of that $2,500 saving next year is?
$2,500.926 is now higher than the present value of paying today, $2,100.
Exactly. In this specific case, the benefit of the 4% rate increase was large enough to overcome the time value cost of waiting 1 year. So here, the optimal strategy flips, you defer the deduction.
Wow, that really drives home the point that you can't just rely on the general rule when rates are changing. You have to crunch the numbers.
You absolutely do. The passkey summary is, constant or decreasing rates generally mean accelerate deductions defer income. Increasing rates require a calculation comparing the rate benefit to the time value cost. Adds a whole different dimension to timing. Okay, let's shift gears from when to who and where. Income shifting strategies.
Right. This is all about deciding which taxpayer, maybe a parent company versus a subsidiary, or the corporation versus its owners, or which geographic location, state A versus state B, or U.S. versus another country, reports the income or deductions.
And the driving force here is simply differences in tax rates between those entities or locations.
Precisely. You want to structure things, legally of course, so that income ends up being taxed at the lowest possible rate, and deductions provide benefits at the highest possible rate.
Focusing first on shifting between jurisdictions, the where.
The general idea is pretty intuitive. Try to recognize income in places with lower tax rates. The source notes that while international shifting has gotten more complex with global tax changes, there are still significant opportunities within the U.S.
Because state corporate tax rates vary so much.
Massively. You have states with no corporate income tax and others up near 10%. That difference is a huge incentive. It really influences decisions about where to build a new plant, where to locate a distribution center, sometimes even where to put the company headquarters.
The Godwin Corp example hits this point. They're based in New York, high tax rate, 6.5%. They're expanding and choosing between South Dakota, which has a 0% corporate rate.
And Colorado, which has a 4.55% rate, still lower than New York, but not zero. They expect $10 million in total income, and $3 million of that will be considered earned or apportioned to the new state location.
So we're looking at the state tax impact on that $3 million.
In South Dakota, it's easy. $3 million times 0% is zero state tax.
In Colorado, it's $3 million times 4.55%, which is $136,500.
So purely from a state income tax perspective on that slice of income, choosing South Dakota saves them over $136,000 a year compared to Colorado.
That's a significant difference just based on location choice.
It really is. And the source points out another layer. Since both potential new states have lower tax rates than their home state of New York, Godwin actually has an incentive, regardless of which state they pick, to see if they can legally increase the proportion of their total income that gets allocated or apportioned to that new lower tax state.
And how is income usually apportioned between states? It's based on things like sales, property, payroll.
Typically some combination of those factors, yes.
Yeah.
States have different formulas. So decisions about where you make sales, where you locate valuable property, where your employees are based, these can potentially shift the apportionment fractions and move more income into the lower tax state.
So it's not just choosing the state, but maybe structuring operations within that state to maximize the tax benefit.
Potentially, yes.
Yeah.
Of course, moving an entire headquarters for tax reasons is a much bigger decision, involving huge non-tax factors, labor pools, logistics, market access, that might easily outweigh the tax savings. But state tax is definitely on the checklist.
Okay, now let's talk about shifting between the corporation and its owners, the who. This often comes up with closely held C corporations, right? Because of double taxation.
Exactly. That's the classic C Corp issue. The corporation earns profit, pays corporate income tax on it. Then, if it distributes what's left as dividends to the owners.
The owners pay personal income tax on those dividends, taxed twice.
Right. So a major goal in tax planning for C Corp and their owners is often finding ways to get money or value out of the corporation and into the owner's hands without it being classified as a dividend. Ways that allow the corporation to take a deduction for the payment.
Like paying salaries to owners who actually work in the business.
That's the most common example. If a shareholder is also an employee providing real services, the corporation can pay them a reasonable salary.
And the corporation gets to deduct that salary as a business expense.
Correct. That deduction reduces the corporation's taxable income, cutting the corporate level tax on that amount. The shareholder employee receives the salary and pays individual income tax on it.
So the income is taxed, but only once, at the individual's rate. It avoids the corporate layer.
Precisely. Let's look at the Amir ABC Corp example. Amir owns 50% of ABC Corp and works there. ABC pays him a $100,000 salary. The corporate tax rate is 21%.
That $100,000 salary is deductible for ABC Corp. The tax saving for the corporation is $100,000 times 21%.
That's just $21,000. The corporation pays $21,000 less in tax because of that salary payment.
Now, Amir has $100,000 of salary income. He has to pay individual income tax. Let's say his personal marginal tax rate is low, maybe 12%.
Okay, if Amir's rate is 12%, his tax cost on the salary is $12,000. 100K, 12%. Now compare the flows. The corporation saved $21,000 in tax. Amir paid $12,000 in tax.
The net effect is a $9,000 tax saving overall, 21K, 12K.
Right. Getting the money out as salary saved $9,000 in total taxes compared to, say, leaving it in the corp and paying corporate tax, ignoring the dividend tax for now. But what if Amir's in a higher tax bracket, say 24%?
Okay, same, $21,000 corporate tax saving. But now Amir's tax cost is $100,000 times 24%.
Which is $24,000. Now, the corporation saves $21,000, but Amir pays $24,000.
The net effect is a $3,000 tax cost, 21K saving 24K cost. It actually costs more in taxes overall to pay it as salary in this scenario.
Exactly. This highlights the critical point. Whether paying salary is tax efficient depends entirely on comparing the corporation's tax rate to the shareholder employee's individual tax rate.
You need the individual rate to be lower than the corporate rate for it to generate overall savings.
Generally, yes. Similar logic applies to other payments from the corporation to owners, like paying rent for property the owner leases to the corporation, or paying interest on loans the owner made to the corporation. The corporation gets a deduction, the owner has income taxed once.
So these are ways to get cash to owners avoiding double tax. But the source warns about pitfalls when dealing with property, especially appreciated non-cash property.
Yes, this is a huge danger zone. Moving appreciated assets like land, buildings, stocks that have gone up in value between a corporation and its owners can trigger unexpected and often unwanted tax consequences. Very different from using cash.
Like when an owner contributes appreciated property to the corporation for stock.
That's one scenario. The source gives the XYZ Corp contribution example. Jason owns 1% of XYZ. He contributes land. He owns basis $10, fair market value $80 in exchange for $80 worth of new XYZ stock. After this, he owns 6% of the company.
Now, normally there's a rule, Section 351, that often lets you contribute property for stock tax-free, right?
Yes, if the contributor or the group of contributors together controls at least 80% of the corporation's stock immediately after the transfer.
But Jason only ends up with 6% control here, way less than 80%.
So Section 351 does not apply to him. The tax law treats him as if he sold the land to the corporation for its fair market value, which is the value of the stock he received.
So he has to recognize gain, the difference between the $80 K value and his $10 K basis.
Exactly. Jason has an immediate $70,000 capital gain he has to report and pay tax on just for putting his land into the company. Ouch.
That's a nasty surprise if you weren't expecting it. What about distributing appreciated property from the corporation to the shareholder?
That's often even worse tax-wise, outside of a formal liquidation. Let's use XYZ Corp again. Suppose the corporation owns that same land, $10 K basis, $80 K FMV, and distributes it to Jason.
What happens tax-wise?
Two bad things, usually. First, the corporation is treated as if it sold the land for its $80,000 fair market value right before distributing it.
So the corporation itself recognizes a $70,000 gain, 80K FMV $10 basis, and pays corporate tax on it.
Yes. The gain is taxed at the corporate level. Then second, Jason receives the land. He gets an $80,000 basis in it, but the distribution itself is generally treated as a dividend to him up to the $80,000 fair market value, assuming the corporation has sufficient earnings and profits.
So the corporation pays tax on the gain, and the shareholder likely pays tax on the full value as a dividend. That's definitely double taxation, and on the appreciation, no less.
It's a tax disaster, usually. These rules essentially make distributions of appreciated property highly inefficient. Unless the transaction fits specific exceptions like Section 351 for contributions or rules for liquidations or certain reorganizations, moving appreciated non-cash assets is generally something to avoid in tax planning.
Good to know. A major constraint on shifting assets around. Okay, we've hit timing and shifting. Let's get practical with estimated tax payments.
Right. This isn't about lowering the total tax bill for the year necessarily, but about paying it correctly throughout the year to avoid underpayment penalties.
It's about compliance and managing cash flow, too. Who has to make these payments?
Generally, any corporation that expects to owe $500 or more in tax for the year, they have to pay in quarterly installments.
And the due dates are pretty standard, right? 15th day of the 4th, 6th, 9th, and 12th months of their fiscal year.
That's right. The tricky part is figuring out how much to pay each quarter. The goal is to make sure your cumulative payments by each deadline meet a required percentage of your minimum annual required payment.
Okay, minimum annual required payment. How do companies figure that out?
There are basically three main ways, three benchmarks they can use. They want to use the method that results in the lowest required payment to avoid penalties, letting them hold on to cash longer.
What are the three options?
Option 1, pay based on 100% of the current year's actual tax liability. Problem is, you don't know that for sure until year end.
Option 2, pay based on 100% of the prior year's tax liability. This is popular because that number is known, but there are important limitations.
Option 3, pay based on 100% of the current year's tax liability, estimated using a special method called the annualizing income method.
Let's talk about the limits on using the prior year's tax. You can't always use it.
Two key limits. First, if the corporation had zero tax liability last year, you can't use it. Second, for large corporations defined as having $1 million or more in taxable income in any of the preceding 3 tax years, they can only use the prior year tax method for their first quarterly payment.
Only for Q1. Then what do large corporations do for Q2, Q3, and Q4?
They must base their payments on the current year's income, using either their actual current year tax projection or, more commonly, if income isn't steady, the annualizing income method.
So large companies often use the easy prior year number for Q1, then have to switch to estimating the current year.
Exactly. And that's where annualizing becomes really important, especially for businesses with seasonal or fluctuating income.
How does annualizing work conceptually?
It lets the corporation calculate its required payment based on projecting a full year's income using the income earned to date. So if you have a slow first quarter, your annualized income projection will be low, and your required Q1, Q2 payments will be relatively low. As income ramps up later in the year, the annualized projection increases and the required payments catch up.
It tries to match the payments to when the income is actually earned. How's it calculated? Involves multiplying by fractions like 123, 126.
That's right. You take the cumulative income earned through a certain period, end of month 3 for Q1, Q2 payments, end of month 6 for Q3, end of month 9 for Q4. You multiply it by an annualization factor, 123, 126, 129 respectively, to estimate the full year's income. Calculate the tax on that annualized income, then figure out the cumulative percentage you need to have paid by that quarter's deadline. 25% by Q1, 50% by Q2, 75% by Q3, and 100% by Q4.
And the payment for the current quarter is just the difference between the required cumulative amount and what you've already paid in previous quarters.
You got it. It's a bit involved, but it avoids penalties when income isn't smooth.
Let's use the Simon Core example to see this in action. Large corporation, fluctuating income. Last year's tax was $2.1 million. This year, income is Q1, $5 Q2, $1 Q3, $6 Q4, $8. Total income, $20. Total tax will be $4 to 2 payments, 21% rate.
Okay, Q1 payment, due month 4. Simon is large, so they can use the prior year safe harbor for Q1 only. Prior year tax was $2.01. Required Q1 payment is 25% of that, which is $525,000.
That's probably less than annualizing the strong $5 Q1 income would require, so they pay the $525K.
Right. Now, Q2 payment, due month 6. They must switch off the prior year method. They annualize based on Q1 income. Q1 income was $5. Annualized income using 3 months. $5, 123 equals $20. Annualized tax equals $4.02.
Oh.
By the Q2 deadline, they need to have paid in 50% of this $4.02.
50% of $4.01 is $2.01 required cumulatively. They paid $525K in Q1.
So the Q2 payment is $2.01 required minus $575K paid equals $1,575,000.
Big payment in Q2. Okay, cumulative paid is now $525K plus 1.575 pay equals $2.01. On to Q3 payment, due month 9, annualized based on Q1 plus Q2 income.
Q1 plus Q2 income, they need to have paid in 75% of this $2.52.
75% of $2.52 is $1.89 in required cumulatively.
But wait, they've already paid $2.01 cumulatively through Q2.
The required amount, $189.10, is less than what they've already paid, $2.11. This happened because Q2 income was low, bringing down the annualized projection.
Exactly. So the required payment for Q3 is $1.89 needed minus $2.01 already paid, which means they need to pay $0 for Q3.
Nice. That shows how annualizing reflects income dips. Okay, last one. Q4 payment, due month 12. Annualized based on Q1 plus Q2 plus Q3 income.
Q1 plus Q2 plus Q3 income equals $5. Meters, $1 plus $6 plus 12 meters.
Yep.
Annualized income using 9 months. 12 months, $129 on $16 Annualized tax at $16 on 21% equals $3.36. By the Q4 deadline, they need to have paid in 100% of this $3.36 annualized tax.
Required cumulative is $3.36. They've paid $2.26 through Q3.
So the Q4 payment is $3.36 required minus $2.26 paid now to $1,036.
And their total estimated payments for the year are $525K plus 1.575 members plus $0 plus $1.26 equals $3.36. That difference gets paid when they file the final return.
And the key insight here is that the Q4 income itself isn't used to calculate the Q4 estimated payment. That payment is based on annualizing income only through Q3.
Correct. It's a look-back calculation for the estimate. That whole process, especially the annualizing part, is quite a dance to manage cash and stay penalty-free when earnings bounce around. Definitely seems like it. Okay, so we've seen timing strategies, shifting strategies, the nuts and bolts of estimated payments. It sounds like corporations have a lot of leeway. What actually reins them in? What are the limitations?
Good question. Because there definitely are limits. It's not the Wild West. You have practical business constraints and you have significant legal doctrines.
Practical limits first. What does that mean?
Well, sometimes the opportunity just isn't there. You might understand NOL carry forward rules perfectly, but if your company doesn't have any NOLs, the strategy is irrelevant. Or you can't control the timing of a major customer payment. Or maybe all the jurisdictions you operate in have similar tax rates.
So the specific facts and circumstances might just not allow for a certain strategy.
Right, and the other big practical limit is just fundamental business sense.
Tax shouldn't wag the dog, basically.
Exactly. A tax planning strategy that saves a few dollars on taxes but messes up your supply chain or requires taking on way too much debt or damages your reputation with customers, that's probably a bad idea overall. Tax savings have to be weighed against the broader business impact.
Makes sense. Tax planning should support the business, not undermine it. What about the legal limits? The source mentions several judicial doctrines.
These are really important. They're principles that have emerged from court cases over many years, and the IRS uses them to challenge tax plans that seem too aggressive or, frankly, artificial. They try to get at the substance of a transaction, not just its form.
What's the first one? Constructive receipt.
Yes. Constructive receipt mainly limits timing strategies for income. It basically says you're taxed on income not just when you actually get your hands on it, but when it's made available to you without substantial restrictions.
The paycheck example. If it's sitting there for you to pick up on December 31st, you can't just wait until January 2nd to grab it and say it's next year's income.
Exactly. You had the right to it. It was available. You constructively received it in December. Taxable in December. It stops easy deferral games.
Okay. What about assignment of income?
This one goes after income shifting. The core idea is that income must be taxed to whoever earned it or whoever owns the asset that produced it.
So if I perform services and earn a fee, I can't just tell my client, hey, pay my kid instead because they're in a lower tax bracket.
Generally, no. You earned it, it's taxed to you. Similarly, if you own stock that pays dividends, you own the asset. The dividend income is taxed to you. You can't just assign the income itself to someone else while keeping the underlying asset or performing the service.
Prevents simply redirecting income flows without a real economic transfer.
Right. And then there are the really broad ones, substance over form and the related step transaction doctrine.
These sound powerful.
They are. Substance over form means the IRS and courts can look through the legal paperwork, the form of a transaction, and determine its tax consequences based on its actual economic substance. What really happened here?
Regardless of how the lawyers dressed it up.
Pretty much.
Hmm.
And the step transaction doctrine is a key part of that. It allows the IRS to take a series of separate, maybe individually okay steps and collapse them into a single transaction. If they were really all part of one prearranged plan designed to achieve a result, usually tax avoidance, they couldn't have been achieved directly.
So if you could get from A to D tax-free, but going from A to B, then B to C, then C to D, using specific legal forms seems to avoid tax, the IRS can say, nope, that was really just a single A to D transaction, and it's taxable.
That's the essence of it. It prevents taxpayers from achieving indirectly what they couldn't achieve directly just by adding artificial steps. These doctrines collectively serve as a major check on tax planning, needing real business purpose and economic reality.
So it's a constant balancing act for corporations. They have these sophisticated tools for timing and shifting.
But they have to operate within the practical needs of their business and under the shadow of these judicial doctrines that demand substance over mere form.
It paints a picture of tax planning as much more than just filling out forms. It's complex strategy within defined, albeit sometimes blurry, boundaries.
Definitely. Navigating that line between legitimate planning and crossing over into abusive territory is a huge part of corporate tax work.
Well, this has been incredibly insightful. We've really unpacked how corporations use timing strategies, playing with the calendar based on time value of money, dealing with NOLs and capital losses, reacting to rate changes.
And how they shift income and deductions, looking for lower tax rates geographically or between the company and its owners, while being super careful about things like appreciated property transfers.
We also got into the weeds of estimated tax payments, especially that annualizing method for companies with uneven income streams, all about avoiding penalties.
And crucially, we looked at the constraints, the business realities, and the legal doctrines like constructive receipt, assignment of income, and substance over form that act as guardrails.
Understanding all this gives you, the listener, such a better lens for viewing corporate finance news, understanding why companies structure themselves certain ways, and seeing that constant interaction between business strategy and tax law.
It really shows tax planning isn't some isolated accounting function. It's deeply woven into the fabric of corporate decision-making.
Absolutely. And maybe the final thought to leave you with is this. Considering all the intricate rules, the planning opportunities, but also the significant legal limitations we've discussed, how much real flexibility do corporations ultimately have to manage their tax outcomes? What does that ongoing negotiation between planning and constraint tell us about the nature of our tax system and the relationship between business and government?
It's a big question, definitely one worth pondering.
It is indeed. Thanks so much for digging into this material with us today.
My pleasure. Always interesting stuff.